Hi, this is John Kamarianos for Capital Considered. I wanted to follow up a recent podcast that we just put up earlier regarding the Shiller PE or the CAPE ratio, indicating that U.S. stocks are expensive. Um, there are some reasons why the average CAPE ratio since 1880 is 17.5, and since 1990 it's 27. That's a very dramatic difference. And the reason is that more of corporate more of GDP is going to corporate profits than to labor. This is really a political question. I don't want this video to be too political, but it's an important question for investors to consider. Should so much of GDP be going to corporate profits? And if something changes politically, will that affect stock prices? I think it will. I think it will affect them dramatically. Let me illustrate what I'm talking about by showing a couple of charts. First, this is the share of gross domestic income that's going to labor. This goes back to 1929. You can see it peaked at around 1969, 1970, and it's come back almost all the way down to where it was in 1929. So labor is not getting a big share of economic output or gross domestic income. The second chart I'm going to show is kind of the inverse of this. We just showed how much of a share of economic output or gross domestic income labor is getting. Now let's show how much of GDP, admittedly a different metric than the last one, which was gross domestic income. This is GDP, but this is how much is going to corporate profits. For a very long time, from 1947 through 1999, that averaged 6%. 6% of GDP went to corporate profits. Then in 2000, something happened. The average since then has been 9.66, call it 9.7%. That's a very dramatic increase. That may explain some of the political acrimony and contention in the country these days. I don't want to put it all down to economics. I don't think economics ever explains everything. But forgetting about politics for a moment, from an investor's standpoint, if things change politically, if labor begins to gain a greater share of the economic pie, whether it's gross domestic product in the second slide or gross domestic income in the first slide, stock prices can and probably should go down. Now, it may be the case that politically that is the right thing to do, that labor should get a larger share of the economic output or the economic pie, so to speak, of the country. But that will lower stock prices. That will likely lower the Shiller PE. That will likely lower the multiples that stocks trade at. In other words, the price to earnings ratio, the price to sales ratio, all of those comparisons of stock prices to economic productivity of the underlying companies. If you're paying more labor, the stock price probably should be lower. Your profitability is lower. Now, AI is going to have some influence on this, to be sure. It may cut labor costs dramatically as more things get automated and get done by computers and software. But these two slides are one way to explain why the Shiller PE has averaged 27 since 1990 and averaged 17.5 if we go back to 1880. No one knows what's going to happen, whether labor is going to get a bigger share of economic output. If fewer people are working, there are fewer people to buy things. And so we're living in sort of strange times right now. But I think these two charts, the amount of economic output going to labor and the amount of economic output going to corporate profits, these two charts explain a lot, and they're worth watching. And AI will throw a wrench into the works here. That's not saying anything new, certainly, but at least we've maybe partly explained why corporate profits are so high lately. Anyway, this is John Kamarianos for Capital Considered signing off. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.